There's a number flashing on your screen right now. If you're looking at any Western precious metals pricing service, you are seeing silver quoted somewhere around $71 per ounce. That number comes from COMEX futures. It comes from the London Fix. It represents what financial institutions agree is the value of silver in the paper markets, where contracts trade hands but metal rarely moves. Now let me give you a different number, $130 per ounce. That is the reported price for physical silver bars, changing hands in retail markets across Tokyo as of yesterday. Not speculation, not a temporary spike, a sustained premium that has persisted for days. Let me make this clear. We are not talking about a 5% difference. We are not talking about normal dealer markups or shipping costs. We are talking about an 83% premium. The same metal, the same purity, the same weight. Two radically different prices separated by nothing more than whether you are buying a promise or buying an object. This divergence is not normal market behavior. This is a dislocation that suggests something fundamental has broken in the pricing mechanism. And if you understand what causes this kind of split, you understand why the next 6 months may reshape precious metals markets in ways we have not seen in decades. Let me start with what this premium actually represents. When you buy silver from a dealer, you expect to pay slightly more than spot price. The dealer needs profit margin. There are fabrication costs. There are logistics costs. In normal markets, retail premiums for generic silver bars run between $2 and $4 per ounce over spot. During periods of high demand, those premiums might stretch to $8 or $10. Even during the retail squeeze of early 2021, when online dealers were completely overwhelmed, premiums peaked at around $12 per ounce in the United States. But $59 over spot is not a premium in any conventional sense. That is not a markup. That is a completely different valuation system. It suggests that buyers in Tokyo are operating under constraints or fears that do not exist in New York or London. And the most obvious constraint is availability. When premiums reach this level, it means one thing. People are willing to pay any price because they believe the alternative, not having the metal at all, is worse. Now, let's talk about why this is happening specifically in Japan. The Japanese yen has experienced significant depreciation over the past 2 years. The Bank of Japan maintained ultra-loose monetary policy longer than other central banks. While the Federal Reserve and European Central Bank raised rates aggressively to fight inflation, the BOJ kept rates near zero to support their economy. That policy divergence caused the yen to weaken substantially against the dollar. For Japanese savers, this creates a problem. Their cash is losing purchasing power, not slowly, measurably, and consistently. Japanese citizens have historically been heavy savers. High savings rates are cultural and practical. But when your savings are denominated in a depreciating currency, you face a choice. You can hold cash and watch it erode, or you can convert into hard assets. Gold and silver become attractive precisely because they are not yen. They are not dollars. They are elements with intrinsic properties that cannot be printed or devalued by central bank policy. So demand for physical precious metals in Japan has surged, not as investment speculation, as wealth preservation. But here's the problem. Japan does not produce significant amounts of silver domestically. They must import it. And the global supply chain for refined silver is not set up to handle sudden surges in retail demand in specific regions. Refiners produce large wholesale bars, typically 1,000-ounce or 100-ounce formats, which are then sent to mints for fabrication into smaller retail products. That fabrication process takes time. When demand spikes in one market faster than supply can adjust, you get shortages, and shortages drive premiums. Now, you might ask why arbitrage does not close this gap. In theory, if silver is $71 in New York and $130 in Tokyo, someone should be buying in New York, shipping to Tokyo, and capturing that $59 spread. Even after accounting for shipping, insurance, import duties, and fabrication costs, there should be enormous profit available. That is how markets are supposed to work. Price differences create opportunities. Opportunities attract capital. Capital flows until the difference disappears. But the arbitrage is not happening fast enough. Why? First, logistics. Moving physical silver internationally is not instantaneous. You need secure transport, you need insurance, you need customs clearance. For large institutional players, this process can take weeks. Second, refining capacity. Most wholesale silver bars are not in a format suitable for the Japanese retail market. They need to be melted down and refabricated into smaller bars or coins. Refining capacity is finite. You cannot simply flip a switch and double output. Third, regulatory friction. Japan has import procedures, documentation requirements, quality certifications. These create delays. And fourth, the most important factor, sourcing constraints. The assumption behind arbitrage is that you can freely buy unlimited quantities in the cheap market. But what if the cheap market does not actually have unlimited supply? What if the $71 COMEX price is a fiction maintained by paper contracts that rarely result in physical delivery? Let me explain what I mean. COMEX silver futures are primarily financial instruments. They allow producers to hedge. They allow speculators to take leveraged positions. They allow banks to manage exposure. But the vast majority of contracts are closed before delivery. Estimates suggest that over 95% of COMEX silver contracts are cash settled. The participants never intend to touch physical metal. They are trading price exposure, not commodities. This creates a situation where paper supply vastly exceeds physical supply. You can have thousands of contracts trading that reference millions of ounces of silver, but the actual metal available for immediate delivery is a tiny fraction of that notional volume. COMEX maintains warehouses where silver is stored. That silver is categorized as either registered or eligible. Registered means it is available for delivery against contracts. Eligible means it meets quality standards, but is owned by someone who is simply using the warehouse for storage. As of late December, registered silver at COMEX warehouses was approximately 240 million ounces. That sounds substantial, but consider that global industrial silver consumption alone is around 480 million ounces per year. The entire registered COMEX inventory represents about 6 months of industrial demand, and that inventory has been declining, not gradually, consistently and significantly over the past 12 months. When registered inventory declines, while paper contract volume remains high, you create a structural vulnerability. The exchange is facilitating price discovery for a commodity it may not have sufficient physical supply to deliver. As long as most participants cash settle, this works fine. But if sentiment shifts, if participants start demanding delivery instead of cash, the system faces stress. Now let's connect this back to Japan. The $130 price in Tokyo is not happening in a vacuum. It is happening because Japanese buyers are trying to source physical metal, and that metal is not freely available at $71. The dealers supplying the Japanese market are not buying from COMEX directly. They are buying from refiners and wholesalers who source from mines, recyclers, and yes, sometimes from COMEX-approved warehouses. But when those wholesalers try to source additional metal to meet Japanese demand, they are encountering delays and higher prices. This is where China enters the picture. As we discussed in previous analysis, China implemented export licensing requirements for silver effective January 1st. China is both a major producer and major consumer of silver. They refine approximately 30 to 40% of global silver supply, even if much of the ore originates elsewhere. By requiring licenses for export, China has effectively created a barrier. Refined silver that would have previously flowed freely to international markets is now subject to government approval. The practical effect is that Chinese refiners are prioritizing domestic demand. China's solar panel industry, electric vehicle industry, and electronics manufacturing all require silver. With domestic demand growing and government policy favoring domestic supply security, less Chinese silver is reaching global markets. This reduces the pool of available metal that dealers in Japan or anywhere else can draw from. So you have Japanese demand surging, Chinese supply constrained, and COMEX inventory declining. The natural result is that physical metal becomes harder to source. And when something becomes harder to source, the price rises. But the price that rises is the physical price. The price actual metal trades hands at, not necessarily the paper price, the price financial contracts reference. This brings us to the bank short position. The Commitments of Traders report, published by the CFTC, breaks down who holds what positions in COMEX futures. The category called commercials, which primarily consists of large banks and bullion dealers, has historically held large net short positions in silver. This is sometimes explained as hedging. Banks take short positions to offset long physical positions or forward contracts with miners. But the size of the commercial short position has often exceeded reasonable hedging needs, leading to accusations of manipulation. Whether manipulation is occurring is a legal and regulatory question beyond this analysis. What matters for our purposes is the mechanical reality. If banks are short silver futures at $71 and the physical market is pricing silver at $130, those banks face a problem, not an immediate solvency problem. Large banks have substantial capital reserves, but a pricing problem. If the paper market they trade in starts to converge toward physical market prices, their short positions lose value. A move from $71 to $100 represents a $29 loss per ounce. On a 40,000 contract position, each contract representing 5,000 ounces, that is 200 million ounces. Times $29, that is roughly $5.8 billion in mark-to-market losses. Now, $5.8 billion is painful for a bank, but it is not fatal. JP Morgan, for example, has Tier 1 capital exceeding $250 billion. A $5 billion loss on silver would impact quarterly earnings and likely result in management changes, but it would not collapse the institution. The The banks have survived losses of this magnitude before in other markets. However, the issue is not just the loss. The issue is what happens if the bank cannot close the position. If they try to buy back their shorts to limit losses, they drive the price higher, making the problem worse. If they try to deliver physical metal to settle contracts, they need to source that metal from somewhere. And if Chinese supply is constrained and COMEX inventory is declining, sourcing becomes difficult. This creates a potential scenario where the banks are solvent but illiquid. They have the capital to cover losses, but they cannot execute the trades necessary to close positions without moving the market against themselves. This is the situation that leads to controlled retreat. The banks slowly unwind positions over time, accepting gradual losses rather than triggering a panic by trying to exit all at once. And this is exactly what we appear to be seeing. Silver prices have risen substantially over the past year, not in a straight line, with volatility and pullbacks, but the overall trend has been upward. That upward movement is consistent with banks slowly covering short positions. They are letting the price rise at a pace they can manage rather than fighting it and risking catastrophic losses. The 83% premium in Japan is evidence that this managed retreat is not preventing physical market dislocation. The paper market may be adjusting gradually, but the physical market is adjusting violently, and the gap between the two is the measure of system stress. Now, what does this mean going forward? I'm not making price predictions, but I can outline scenarios based on historical precedent. If Chinese export restrictions remain in place and physical supply continues to tighten, premiums in physical markets are likely to remain elevated or increase further. This will create pressure for paper prices to rise, not because banks suddenly decide to let prices run, but because the divergence becomes unsustainable. At some point, participants holding paper contracts will start demanding delivery instead of accepting cash settlement. When that happens, exchanges face a choice. They can deliver the metal, which depletes inventory further, or they can change the rules. History suggests exchanges protect themselves. In situations where delivery obligations threaten system stability, exchanges have imposed position limits, raised margin requirements, or in extreme cases, suspended trading and forced cash settlement. The London Metal Exchange did this with nickel in 2022. When nickel prices spiked due to a short squeeze, the LME halted trading, canceled trades, and imposed settlement at a fixed price. Participants who were profiting from the squeeze lost those gains. The exchange prioritized system survival over individual contract rights. If a similar situation develops in silver, COMEX could take similar actions. This is why the distinction between paper and physical matters. If you hold physical silver in your possession or in allocated storage with clear title, an exchange rule change does not affect you. Your metal is your metal regardless of what COMEX decides. If you hold futures contracts or shares in unallocated ETFs, you are subject to rule changes, forced settlements, and counterparty risk. The Japanese premium is a warning. It is telling us that in some parts of the world, people are already treating paper prices as irrelevant. They are paying whatever is necessary to secure physical metal, because they do not trust the paper system to deliver when it matters. Whether that distrust is justified depends on whether you believe the paper market has sufficient physical backing. The declining COMEX inventory and persistent shortages suggest that distrust may be warranted. For those considering positions in silver, the decision framework is straightforward. If you believe the paper and physical markets will remain aligned, then paper exposure is cheaper and more liquid. If you believe the markets are diverging and physical supply is genuinely constrained, then paying premiums for physical metal is the price of certainty. The 83% premium in Japan represents the extreme end of that calculation. Japanese buyers have concluded that certainty is worth paying double. Whether that calculation is rational depends entirely on what happens next. I will continue monitoring this situation. The data points to watch are COMEX registered inventory, Chinese export data, and physical premiums in major markets. If inventory continues declining and premiums remain elevated, the pressure on the paper system will intensify. How banks and exchanges respond will determine whether this becomes an orderly repricing or a disorderly one. Until then, the message from Tokyo is clear. In a world where paper and physical are diverging, some buyers have already chosen which reality they trust. The question is whether that choice will prove prescient or premature.